Hey everyone, this is Hunter Satterfield, a partner here at CWA and a member of our investment committee. I am joined as always by one of my fellow partners, Brian Bortz, who is also the head of our investment committee, and then also the managing director of Tectonic Advisors, Brad Sanders. This is your October monthly update. For the month of October, we saw the S&P 500 soar higher at 7% gains for the month. Global stocks were up 4.9% for the month. Domestic bonds were flat, right at 0% for the month. And then global bonds were just slightly down at about 0.2% for the month. So what a crazy and wild month coming off of September, which was a bit of a down month. And Brad, let me start with you from what your team is seeing kind of on a daily basis. We saw a big down in September, a big up in October. Can you talk a little bit about what y'all are seeing on a daily basis and sort of what is going on with the markets right now?
Yeah, I mean, really, October was just a resumption of what we've kind of seen for the majority of 2021, which is just, and we've repeated it almost ad nauseum at this point, but the market just, to us, has wanted to go up all year. And you get a month like September and it starts to scare people. That's why we were just constantly reiterating this market wants to grind higher, just stay engaged. There's just been a bid to the market all year. There's sort of like an animal spirits kind of feel to it where bad news gets shrugged off and the market just kind of keeps chugging ahead. Now we've seen some volatility in the top end of the indexes and some of the big tech stuff. So the market's starting to look like maybe we're going to have a change of narrative, change of leadership, some things like that could cause some volatility in the shorter term. But that doesn't mean that the market doesn't continue to move higher. It just means that what's propelling the market might be a little bit different. And we just think for the rest of the year, it's kind of the same story that it has been all year. I think we said in January, there's very little economically that we were worried about this year, and that we felt like the market would grind higher all year. And I don't think it's going to change for the last 2 months. Now, the Fed's going to maybe they're going to announce they're going to start tapering tomorrow. At least if we believe what they've said in the past, unless they change their stripes at the last second. And in the past, when the Fed has started tapering their asset purchases, it has caused some volatility in the market. So we're not saying, it's going to be a straight line up the rest of the year. If the Fed starts doing that, the market may react, because that does change some of the liquidity parameters within the bond market, things like that can cause some things to kind of get moved around and shuffled around in the short term. But really, we just think stay engaged with this market, do it in a smart way, and just let it work for you, because it certainly seems like it wants to, and we need to get out of its way, from a human behavior standpoint.
Yeah, of course. And that's actually, Brian, I think is a good segue over to you, things that you and I talk about almost daily as we communicate with our team here of advisors. And can you talk a little bit about, you see a month like September for investors, which is down, and the fear and anxiety that may create, but then you see a month like October that's up, and what do we want to communicate to, investors and our clients about how we want to approach sort of the long-term approach of investing?
Yeah, thanks, Hunter. One of the things that I think is really important for our investors and our clients to understand is that taking a longer term approach also helps to mitigate volatility over time. Bloomberg actually just did a really recent study, and it looked at 20 years in the market. It looked from 2001 to 2020, and the average return on the S&P during that time was about 7.5% annualized over those 20 years. If you took out just the 10 best days over 20 years, if you just took out 10 days, it cut the return in half. It went down to 3.4% a year for 10 years or for 20 years. So, I mean, the point to that is, and we try to educate our clients in saying there's just as much risk of being out of the market as there is in being in the market in a smart way. So, we try to tell our clients, look, we have a game plan. The way that we try to invest is to dampen volatility, to protect on the downside without giving up, the upside potential that you have. And that's really what we've done, and we've been able to show in our performance. I've been very, very pleased with how we have reacted through the volatility, because our portfolios just have not been as volatile as the market in general. So, the key to remember is you're going to have months like September, and then you're going to follow up with months like October, and you just don't know when they're going to happen. And trying to predict that and be ahead of that is folly. So, helping everybody to understand and stay a long-term focus, mitigate your risk, mitigate your volatility, I think is really the message that we want to get out to everybody.
Yeah, and absolutely. And thank you, viewers, as always. We're going to have a lot more, obviously, before the end of the year. We may have new tax policy. We may have, continued things that create, especially messaging from the Fed, that creates some further stuff in the market that's happening. So we'll be back in front of you in a month with our November update. In the meantime, I hope everybody has a wonderful Thanksgiving, and stay tuned for more information from our team. Thank you so much.